The next financial crisis isn't going to begin with a stock market crash. It won't start with a bank failing, and it certainly won't start with something obvious that most people would recognize as a crisis. Curious, instead, it will emerge in a market that nearly everyone has never heard of, never considered, and never worried about. By the time it makes headlines, the damage will already be extensive. So why isn't anyone talking about it? Size. Because this financial battle is already happening. It's unfolding in real time across 3 invisible arenas that touch every economy in the world, and the tools being used aren't sanctions or tariffs. They're far more precise, more dangerous, and much harder to defend against. Mainstream financial media keeps searching for a repeat of 2008. They watch for subprime exposure, over-leveraged banks, housing bubbles. But the global financial system has changed fundamentally in the past 15 years. Vulnerabilities have shifted, pressure points have moved, and those who understand these changes are already positioning themselves while most observers are looking at the wrong indicators. There are 3 systems converging today. Each alone might be manageable, but together they create a fragility that no central bank, Treasury Department, or international institution is equipped to handle. These are the 3 invisible fractures. The first is the sovereign debt trap, the second is the currency bifurcation machine, and the third is a shadow liquidity crisis hiding in plain sight. Let's start with the sovereign debt trap, which is closest to snapping. Many think sovereign debt is just a number. A country owes money, pays interest, and life goes on. But the reality is far more alarming. Global sovereign debt reached exactly $97.1 trillion at the end of 2024. The real problem isn't just the amount, it's how the debt is held, how short the maturities have become, and how limited the exit options are. A former central bank advisor in Singapore once explained it to me this way: the problem isn't the size of the debt. The problem is that the buyers have changed, the maturities have shortened, and the exit doors have gotten smaller. A decade ago, sovereign debt was mainly held by patient, long-term investors like pension funds, insurance companies, and central banks. Today, hedge funds and leveraged traders dominate much of the trading volume in U.S. Treasuries, with basis trades alone reaching an estimated $1.2 trillion by mid-2024. These aren't patient holders. They can exit in hours. At the same time, governments are issuing shorter-term debt to avoid locking in high long-term rates. In the U.S., short-term Treasury bills under 1 year now make up over 22% of total marketable debt, exceeding advisory recommendations. Short-term debt requires constant refinancing, so any liquidity shock, geopolitical event, or sudden shift in risk appetite could trigger immediate pressure. This isn't just an American issue. Japan's government debt is 263% of GDP, France's exceeds 112%, and emerging markets from Brazil to Egypt are struggling with interest rates that strangle investment. The sovereign debt trap is a slow, suffocating pressure that sets the stage for the next fracture: currency bifurcation. While the sovereign debt trap is about governments slowly over-leveraging themselves, the currency bifurcation machine is quietly splitting the global monetary system into competing networks. Few analysts fully understand this shift because they still think in a single currency world. In 2000, the US dollar made up roughly 71% of global central bank reserves. By 2024, that share had fallen to 57.4%, and the decline is accelerating. The replacement isn't the euro, yen, or pound, it's a basket of non-traditional currencies and gold. Central bank gold purchases hit record levels, exceeding 1,000 tons per year, the likes of which haven't been seen since the 1960s when the Bretton Woods system was under stress. Behind the scenes, an alternative financial infrastructure is being built. China's cross-border interbank payment system processed $123 trillion in transactions in 2023, a 27% increase from the prior year. Russia and China settle most bilateral trade in yuan and rubles, bypassing the dollar. India is paying Russia for oil using rupees and dirhams. Saudi Arabia is even discussing non-dollar denominated oil contracts. These aren't isolated events. They're part of a growing network of alternative financial systems that could eventually rival the dollar-based system. Here's the paradox. The dollar's strength as a global reserve currency has become a vulnerability. Maintaining this status requires the U.S. to run persistent trade deficits, exporting dollars through imports. This is known as the Triffin dilemma, understood theoretically for decades, but never in a world where a credible alternative financial system exists, while the U.S. runs a 6.3% GDP fiscal deficit during peacetime with unemployment under 4%. In 2024, the U.S. federal deficit reached $1.83 trillion, needing buyers for Treasury securities at the same time that foreign demand is retreating. In 2015, foreign entities held 34% of Treasuries. By 2024, that share dropped below 24%, shifting demand to domestic institutions and leveraged speculative players. The third fracture, the shadow liquidity crisis, links the first two into a potentially explosive system. After 2008, banks were better capitalized, with stricter regulations and stress testing. But risk didn't disappear. It migrated into the non-bank financial sector, including hedge funds, private credit firms, money market funds, pension strategies, insurance companies, and special-purpose vehicles that operate between regulatory gaps. This sector now holds over $217 trillion in global assets, larger than the entire regulated banking system. Even regulators have only partial visibility, estimating they see perhaps 60% of the system. The other 40% represents the largest blind spot in modern finance. Shadow liquidity amplifies stress. When sovereign debt markets wobble, leveraged positions in the shadow system magnify the problem. When currency markets shift, synthetic positions and cross-currency swaps transmit shocks across borders instantly. It doesn't create crises alone. It turns manageable stress into systemic events. We've already seen previews. In September 2022, the UK gilt market nearly collapsed due to leveraged pension fund strategies, forcing emergency intervention. In March 2023, Silicon Valley Bank's failure triggered a rapid deposit run, with money market funds and reverse repos redirecting liquidity in ways regulators couldn't fully control. Global leverage in non-bank sectors continues to grow. Hedge fund treasury basis trades, sometimes leveraged 50.1, exceed $1.2 trillion. Any significant unwind could cause extraordinary selling pressure in the treasury market, the same market where maturities are short. Foreign demand is declining, and the U.S. government must refinance trillions quarterly. The sovereign debt trap, shadow liquidity crisis, and currency bifurcation converge on the supposedly safest market, U.S. Treasuries. Looking at all three fractures together reveals what I call the invisible convergence, a system where each fracture amplifies the others in ways traditional risk models cannot capture. Traditional models assume liquid treasuries, dollar dominance, and visible leverage. Those assumptions are simultaneously degrading, quietly, without triggering any single alarm, yet creating the most dangerous macro environment in decades. A former IMF official once said, "We have the tools to fight the last crisis. What we don't have is the capacity to handle a crisis that spans sovereign debt, currency shifts, and shadow leverage at once. That's a three-front war, and our institutions are designed for one front at a time. The Fed can provide liquidity, but it can't make foreign central banks keep buying treasuries. The Treasury can adjust issuance strategy, but not hedge fund leverage. The IMF can coordinate, but not force countries to remain dollar-centric while alternatives grow." There are three potential scenarios. Scenario 1 is soft recalibration. Institutions act early, extending debt maturities, slowing currency bifurcation, and regulating shadow leverage. This requires time, coordination, and political will. A 15% chance, realistically. Scenario 2 is a slow fracture. No single dramatic collapse, but gradual system fragmentation. The dollar loses marginal pricing power, sovereign debt consumes budgets, shadow liquidity events occur periodically, and growth stagnates. This is the most likely outcome, roughly 60%. Scenario 3 is a sudden snap, a failed treasury auction, major sovereign default, or simultaneous unwind in shadow markets triggers a cascading liquidity crisis faster than authorities can respond, with parallel currency systems accelerating capital flight. 25% probability, but extreme impact. The takeaway: the financial system trusted to be stable is undergoing a profound structural transformation now. The question isn't if these fractures matter, it's whether you recognize them before most of the world does. Terra Alert News will continue to analyze these developments weekly, exploring what they mean for wealth, markets, and global power in the coming years. The invisible convergence is already underway. The only question is who will see it in time.